This episode of Bulletproof Cash Flow is brought to you by Realty Dynamics. Learn how people like you can build substantial passive income while creating wealth for the long term through real estate investing. Visit rdyne.com. That's RDYNE.com.
And so I always ask folks when I'm talking to them about investing in retail is, what percentage of sales do you believe happen online versus in brick and sticks? And usually they say, anywhere between 60 to 80% online. And it's actually it flip-flopped, it's the other way. And so I think that's really important. So there's a big education component, and then understanding and being able to communicate what we're going to do to these shopping centers to actually, add value to them is another component of this, because, I can tell somebody, well, we're going to go in, we're going to put granite in, we're going to do, flooring, we're going to do paint, we're going to do lighting and all, cabinets and all those things on a multifamily project.
Working because you want to, not because you have to, is financial freedom. And we want to help you create that. Welcome to the Bulletproof Cash Flow Show. We're going to teach you how to achieve lifetime financial freedom through real estate investment. Your host is a multifamily syndicator and property developer. He's done deals reaching into the hundreds of millions of dollars. You'll hear from experts in all aspects of real estate investment, finance, development, and management. Everything you need is right here. This is the Bulletproof Cash Flow Show. And this is your host, Augustino Pintus.
Hey folks, ever wonder how you found this podcast? Was it LinkedIn, Instagram, a tweet? Well, here's the deal. I don't do ads. I don't do sponsorships. All I ask is that you pay it forward. If someone shared or recommended this podcast to you, do the same. A review, a mention, anything helps. Thanks so much. Hey everyone, it's Augustino. If you're looking to blow up your real estate business, I found that you need to create systems and strategies to reach success much faster. You have to have some personal accountability, of course, but it comes down to being productive and leveraging other people's skills and resources. Now, our next guest knows all about this. Back in early 2018, after corporate had pretty much let him down one too many times, and I know the story of that, he decided to jump into real estate syndication. Now, he's done well over 80 successful real estate transactions, millions of dollars completed for investors annually. He's built a huge track record for investment clients that has helped secure their business and their wealth. And now he's actually transitioned away from multifamily and is doing a lot more commercial these days. So since then, aside from acquiring over 1,100 units on the multifamily side and refinancing and returning all the investor capital, now it's all about doing a lot of commercial business and building that part of the business up. So with all that, I'd like to welcome my good friend, Logan Freeman, to the show. Logan, buddy, thanks for coming on, man.
Man, Augustino, thanks for having me. Excited to be here. Yeah,
you bet. It's been a little bit. Excited to have you back on. So guys, if you like what Logan has to say, you can reach him via his contact page at FTW Investments, LLC.com. Okay, Logan, go ahead and tell listeners a little bit about your journey, how you got started back in 2018 and what you're catch us up to what you're doing today.
Yeah. So, after corporate America let me down, I decided to kind of take matters into my own hands and, frankly, did this in a couple different ways. I wasn't 100% sold on just doing real estate. So at the time I was, doing a lot of sales. And so I started to do sales consulting for companies. And at the same time, I found a job as a head of acquisitions for a $50 million fund here in Kansas City. These guys were buying single family homes cash. They were renovating them. They were renting them out. And then when we had about 265 of those, I helped those guys go through a CoreVest portfolio refinance, which really opened my eyes to the syndication and larger scale real estate model. And but I didn't want to do it on single family homes. I saw the scale that was necessary. I saw the man and woman power it took to manage those assets on a regular basis. And the market was shifting. A lot of people were looking for homes to buy in. And so when you're an investor trying to compete against an owner occupant, all objectivity goes out the window. They need a place to live. They love that home and they're willing to bid it up. And so prices started to get a little bit out of whack. So I decided to really start to focus on brokerage of 1031 exchanges. And so my thesis was I'm going to find buyers that I can then go source properties for. And what I found in that niche market was a big need for a consultant type of real estate broker. And so I've built a business on the commercial real estate brokerage side, helping those folks find their next property in Kansas City. Alongside that, started to put some deals together for our private equity business and started to buy smaller multifamily units. And this would be 50 or under, complexes that we were purchasing. And this is in 2019 and pre-COVID, so it seems, that we're 3.5 years into this thing now, maybe even 4. It seems like a long time ago, but at the end of the day, it's, going into COVID, everybody didn't know really what was going to happen when March 18th or whatever the date was. And so we had $35 million of shopping centers under contract to purchase and renovate and lease up. And when that happened, we just decided to say, look, we're going to give the retail market a little bit of time to normalize and figure itself out, and let's step really heavily into multifamily. And so we were able to add about 1,500 units to the portfolio across 4 different states: Missouri, Kansas, Nebraska, and Iowa. And so we stopped purchasing multifamily about 18 months ago when prices just really seemed to be kind of out of whack. And so we said, okay, now we've got 2 years of data for these shopping centers, see how they've operated, see what the challenges have been, and we step back into that market. And we've picked up 4 shopping centers here in Kansas City, working on the 5th one. We also added a big flex industrial project out in Olathe, Kansas, 215,000 square feet, and then bought a 40,000 square foot office building that I'm sitting in right now and renovated and leased that up as well. And so we're sitting here in October of 2023 doing our first acquisition. So that's a really big change for us, right? As an acquisitions business, it's very difficult to have a staff that we do and all of the different things when you're not doing real estate. And so what we found to be really successful is there needs to be other ancillary lines of business, whether that be the brokerage or potentially property management, asset management, those types of services that you can have as a true owner-operator to try to ride out these storms. Our goal is to get ready for the next buying opportunity. We believe, like Sam Zell said, that opportunity is very often embedded in the imbalance between supply and demand. So that could be rising demand against flat or diminishing supply, or flat demand against shrinking supply. And at some point, those 2 lines are going to intersect. And when they do, people are going to make money. So if you believe that thesis from the late, great Sam Zell, then you look at the multifamily pipeline of supply that we're at right now and where starts are right now, and other asset classes. There are opportunities even at historically high interest rate levels that we are at, or at least the last 15 years where we're at today. And so what we're trying to do is exploit those imbalances. And so about 2 years ago is when I started to shout from the rooftops that neighborhood retail shopping centers are going to be great assets to own long term, and that e-commerce is not going to take over the world. In fact, 86% of all retail sales still happen in brick and mortar. And so that is an incredible data point to realize that if you have well-located shopping centers or single tenant net lease projects in a high trafficked area surrounded by good neighborhoods, and you have a good product and service, there's money to be made there. And so we've been really just educating investors about the commercial side of investing. Still love multifamily, but at this, everybody needs a roof over their head, and everybody says that, but it still has to make sense from an intrinsic value and basis standpoint. And when people are buying properties that are 10 or 15 years older than new properties, and your basis is higher, that just doesn't make sense. And Sam Zell talks a lot about that in his book, Am I Being Too Subtle? And so we're kind of going through a change in thesis, and necessarily we have to pivot with where the market is, and all of those changes and challenges come to create opportunities. And so we're staying on the field, we're staying active, we're looking for the next buying opportunity, and really focused on operations. So just beefing up the back office to make sure that we can ride out the next storm. Or this storm that we're going through, man.
We're in the storm now. Yeah, I think we're in the eye of the storm. It's like the media will tell you different, but we are in the storm right now. Yeah,
exactly.
Absolutely. So yeah, it's interesting because I think when we last spoke, you guys are making a heavy push in multifamily the same way we are. Mm-hmm. And yeah, these days we're doing net lease, like we talked about earlier, a single tenant net lease specifically, and a lot more development, more of the affordable housing component is where we're headed. And but it is like you said in your case, shopping centers. So let's talk a little bit about shopping centers and some of the industrial stuff. So the shopping centers, you're talking about strip centers, right? Like strip malls, right? Is that right?
Yeah, you can kind of look at these as neighborhood centers, which would be surrounded by good residential neighborhoods, typically, 25 to 50,000 square feet, 10 to 20 different tenants in there, a lot of e-commerce resistant service-based tenants. So your dentist, your physical therapy, a lot of salons, maybe some restaurants, some financial institutions. Those are kind of the tenant mix for these deals, not necessarily large, big box or even junior box spaces, right? So we look for these centers that don't have any one space to be gross leasable area over 10 to 15%. So we can spread that risk out and ensure that the tenants can, keep up with the cash flow. One thing that happened during COVID with owners of these neighborhood retail centers, if they had a weak retailer in there, they got weeded out. If you couldn't make it, then they shut the doors and they moved out. And so landlords, even the mom and pop owners, got really serious about the tenants that they put in these good shopping centers because they didn't want to have to move somebody out and do another build out and try to go find another tenant and pay the leasing commission. So you have this asset class that has actually strengthened, and the construction supply for this asset class the last 10 years has been extremely low because of the threat of e-commerce. And so they weren't building this. And so what did they build around it? Well, they built single family home neighborhoods and they built multifamily buildings. And so now there's nowhere to put these new shopping centers, even if you wanted to. And so you have an asset that is got a lot less, supply than there is actually demand. And they're performing really, really well. So, and I think the biggest thing to make sure people understand about these shopping centers, location is crucial, right? You don't necessarily want a destination spot. If you're living in an apartment complex, that's your destination, right? That's your home. Like, you're going to drive a little bit off the beaten path potentially to find that. But if you have a shopping center that's hard to get to, the traffic counts are low, one, you're not going to attract the good retailers that you want to put in those spaces, but two, people aren't going to come. And so that's really important. So it's a higher barrier of entry for these shopping centers because there's less of them. There's not necessarily all of them being marketed all the time on LoopNet or even brokerages. And so you have a high barrier of entry that if you can find the right asset for a good basis, long-term thinking in this investment asset type is what we're focused on, and you can do really, really well. And not to mention the beauty of triple net leases, right? I think that is something that is absolutely wonderful. And yes, multifamily is sexy. That's what everybody talks about. But at the end of the day, I've got a lot of mentors that have never done a multifamily property. I remember one of them looked at me early on in my career and said, after I pitched him one of our deals, he said, Logan, great pitch, like the deal, but I've had a thesis from day one that I didn't want people living in my real estate. And I was kind of like, what? And now, owning and managing over 1,500 units, I absolutely understand why he said that.
Yeah. It's a whole different animal. It's a very different animal. Certainly the upside on multifamily, well, how should I put it? There's way more levers on a multifamily asset to improve it, to drive NOI. On the type of stuff that the commercial side, strip centers, single tenant net lease, way fewer levers, but the return is fairly consistent, and yet you typically have guarantees on lease, you can almost guarantee, even though we can't say guarantee a return, right? So there's a high degree of confidence in the deal performing, that's the appeal of it there. So it's almost like they are apples and oranges just because it's two very different asset classes. But in the types of stuff that we do like, usually it's a franchise or a corporate tenant, publicly traded or very large private company. But in your case, like, tell us a little bit about the tenants then. It sounds like if you're doing a strip center, it could be an independent company, maybe a hair salon or whatever the case may be. Like, what sort of tenants are leasing that type of space, and how do you get comfort to know that they won't just disappear in the middle of the night and just take all their stuff and leave? Like, how do you know that?
Look, the small businesses and entrepreneurs are the backbone of the United States economy. And so I think that we have a thesis that we love small businesses and we want to support them in the neighborhoods that we're operating and active in. And I think that, for these shopping centers, you will have a mix of national, regional, and local credit tenants, right? So the larger retailers typically are in really new and nice shopping centers because they're always willing to kind of move their locations because they have they have a customer base that knows the brand, right? A franchise does. However, if you are, John's chicken spot, then you have built a reputation of that location, and you've got a built-in customer base that is around you in that area. You don't have that brand presence, right? And so I think that the tenants could be a little stickier on the local and regional credit tenants than the national retailers. However, yes, they don't have these great guarantees that you have on these national credit tenant deals, but that's why we focus on these multi-tenant shopping centers that have that risk spread across 15 to 20 different businesses in there. And so what I have found that, you work with these individuals, the salons, the local restaurants, the dentist, the physical therapist, the chiropractor, and you just have to evaluate them as business people, right? I mean, you're inherently going to ingest a lot of folks when you buy a retail shopping center, but tenant relations is a really big component of these shopping centers, working with these tenants and making sure that you're not just implementing a business plan that puts them out of business because they can't keep the space. Now, there may be strategic ways that you want to get a tenant out of there because they're in one of the best spaces and they're not willing to move their market rate up on the rental rate. And so you do just say, hey, look, at the end of this, it's either you pay this or we're going to move you out, and we know we can go release that space. The other part of this is the big component is making sure you're buying in the right submarkets. And so we look for submarkets that have vacancy under 7%, right? So even if they did want to move, a lot of times there's not any space for them to go move into. And they are small businesses. So if the landlord is not willing to pay for the tenant build out, so the tenant and landlord contributions, then, they have to come up with money to build their new space out. And that can be prohibitive for them to move as well. So, we've found comfort in that now that we've got some scale in the market, and we have really good relationships with the folks that are leasing these properties to know, who's in the market, who's not, who's looking to expand, who's looking to move. And that's another component of the asset management side, is making sure that we're staying in touch with the leasing brokers that are in touch with these small businesses and medium-sized businesses. So again, a lot of work to be had, and that's kind of a competitive advantage of being here in Kansas City and working on these deals, because to do that externally and not be in the market that you're in is really difficult, right? It's not just like we have a third-party property manager that you can put in place, and then they're also going to bring a great leasing team and all of those different components. We may have a manager on a shopping center, and there may be a completely different leasing team that's involved in that, right? And so there's a lot of different levers on that you need to make sure that you're working in the right direction to implement these business plans. But I think being very picky with the assets that we are purchasing is extremely important. For example, we look for no less than 20,000 cars per day. We look for buildings that were built in the 70s or newer because of some of the construction constraints on those fronts. We look for mom and pop owners that haven't had the capital to put back into the shopping center to make sure that they can move the market rate. So we're not really just buying a coupon. I have brokered a lot of 1031 exchanges into, deals that have been completely renovated. They have triple net leases in them, and they're just buying a coupon. But that's a lot harder today than it was, 3 or 4 years ago. And so we're looking to actually add some value through the cosmetics, through the operations, that we can justify going in at a certain basis, and we know we can push rental rates because we've done it on other shopping centers now.
Yep. Good. And I think, if I'm not mistaken, usually the valuations on those strip centers that don't have the corporate backed tenants will sell for a higher cap rate than, say, a string of single tenants. Because we buy a lot of single tenant stuff. That's what our group does. And yeah, I mean, we see some of these cap rates are even today, they're so compressed. I don't know how these guys justify their pricing, honestly. But on some of the strip centers, yes, I think that you're I'm going to use air quotes here, giving up some cap rate, some return in favor of a tenant that may not be as well recognized as, say, Dollar Tree, right? So, but it comes down to management at that point. Hey, my fellow Bulletproof Cash Flow enthusiasts, I want to take a moment to thank you from the bottom of my heart for being an integral part of our fantastic community. Your support truly means the world to me and the entire team. If you've been enjoying this valuable insights that we've been sharing here, here's a humble request. Could you please subscribe to the show and leave a review on Apple Music? By doing so, you help us deliver more top-notch content and connect with even more passionate investors just like you. Thank you so much for continued support, and let's jump back into the show.
It does. Like, and I think, too, we're typically buying deals that have modified gross leases or gross leases in them, and we have the ability to maneuver those into triple net leases. And so if you're looking at a shopping center that is 90% occupied versus another one that's 90% occupied, but one has CapEx issues and it's got gross leases in it, the other one is fully renovated and all triple net leases, you might have 150 basis points of spread there from the cap rate that you can go into, right? So we're looking for the ones that we can go in and actually add the value to. Just a little bit of a different, philosophy in regards to what we're looking for, but there's plenty of folks that I work with on a regular basis that say, hey, I do not want to mess with anything. I'm selling a fourplex in, California. Find me a shopping center that I can put a manager on place, and the WALT, or the weighted average lease term, is 5, and I don't have to touch that thing for 5 years. And so that can be another asset strategy for individuals. And so our thesis is to aggregate enough scale in this type of asset that lets us go to a larger group and say, look, you've wanted neighborhood retail exposure, and it's hard to do at scale. We've aggregated 1 million square feet. We've implemented the business plan on 9 out of the 10 of these shopping centers. So there's one that needs to be done. You can come in and purchase 1 million square feet instead of a 50,000 square foot shopping center. And I think that we might find some cap rate compression in doing that in a portfolio model as well. So that's another longer term kind of, philosophy and strategy that we're trying to implement here in Kansas City.
Nice. Good. So we talked in the green room about how you're raising money for these types of deals. Now, we always do a blind pool for the net lease assets, just because with a blind pool, we're raising for a return. So we have to give our investors a level of comfort in knowing that we're going to make the right decisions in buying certain assets to fill the fund. But in your case, I think you said you're still syndicating these deals one by one. Is that still accurate? Yeah. So tell us a little bit about that process then. How does that process work? Is it different than from when you're raising for multifamily? Is your pitch a little different, or is it pretty much the same thing?
Yeah. So I think that the strategy or the process is about the same, but what I found is you have to have a lot of education going into these deals, because most people will say, look, Amazon's taking over the world. Wow. Okay, let me just throw a good stat at you. While Amazon makes up about 38% of the United States e-commerce market, it accounts for about 6% of all retail sales. And so that's no monopoly, right? So you have to be armed with the right data and be able to point to the sources to back that up. And so I always ask folks when I'm talking to them about investing in retail is, what percentage of sales do you believe happen online versus in brick and sticks? And usually they say, anywhere between 60 to 80% online. And it's actually it flip-flopped, it's the other way. And so I think that's really important. So there's a big education component, and then understanding and being able to communicate what we're going to do to these shopping centers to actually, add value to them is another component of this, because, I can tell somebody, well, we're going to go in, we're going to put granite in, we're going to do, flooring, we're going to do paint, we're going to do lighting and all, cabinets and all those things on a multifamily project. Well, for a shopping center, it's like, look, we have to go in, address the main issues that are affecting the tenants on a regular basis. That's lighting, that's security, that's parking lot, and that's outdated facades, right? So those are all components that we have to make sure that they understand that we have a program in place to actually implement over time. And the way that we go to our tenant base to say, look, you're on a gross lease right now. We're going to move you a triple net lease. Here's our business plan to actually make the shopping center better. We're going to raise occupancy, which is going to bring more people to your business. And we're going to be really careful about the tenants that we put in the building so you guys can cross-sell from one location to the next. And after you do that and you say, look, if we implement this business plan and add this value, more people are going to come to the shopping center. Typically, you can get people to buy in. And so that's kind of been the strategy on this side. And, talking to investors, I think a lot of people are also looking for diversification, inside of their commercial real estate portfolios. And so, whether that be self-storage or, industrial or something along those lines. But I think that people have made a lot of bets on value add deals that needed, rents to continue to increase. And, they may be in positions on some of those that aren't the best. And here's an alternative to that: fixed rate financing, 85% lease going in. We've proven it across the street on a few different shopping centers. Here's the cash flows. It's not a sexy sell, and it's not, this big cap rate compression when we go to sell. However, you can expect likely more consistent cash flow. And I think that that's been well received in the market is cash flow is king on a lot of these deals. And so that's how we've pitched it. It's been well received. We're working on our 7th triple net lease deal here in Kansas City. And, it's taken some time to get the investors to see the opportunity. But I think that after the Wall Street Journal started to post about, retail shopping centers and writing articles about it, that really opened a lot of people's eyes about them, shopping centers being the darling of the commercial real estate industry. So that helped as well, just getting the word out. And I think that people looking for alternatives to multifamily and retail can be a great asset.
Yeah, I think that it's a very different ask. I would imagine that your investor pool, when you first went to them the very, very first time with this strip center commercial type scenario versus multifamily, they were probably like, what is this? I don't understand this, right? But for all those reasons you just said, it's a very different asset class. It's a risk-adjusted return. Are you going to become a multi-billionaire just buying strip centers? Probably not. However, if you want steady, very, very steady returns, I mean, you're probably doing quarterly returns, right?
Yeah.
I know. Yeah. So we're doing monthly returns on ours, but we can because we know that every single month those corporate tenants are always paying the rent. So we're not worried about it, right? But even it's the same thing on your stuff. You just do it at a different timing. But yes, I mean, they're always paying the rent no matter what. It makes for a very compelling case study, in terms of what the investor can expect. So
I would agree.
It really is a great way to get that cash flow, especially as we continue down this road of a whole lot of uncertainty, a whole lot of how should I say, all the economic situation, I guess is probably the best way to put it. Do you still get those guys that you talk to though that I don't want to sound like a jerk or anything, but they're super greedy. I want 20% IRR. It's like, guys, it's 100K. Like, it's like you're not going to turn 100K to 400K by investing in a multifamily, let alone a net lease. Do you still have those guys?
Yeah.
Like
I think there's been a huge reset with not only the bid-ask gap between sellers and buyers, but with investors and operators. And so I think that there's a big change going on, and you have to just know that the last 10 to 12 years have been a massive, bull run on the commercial real estate side in multifamily, especially. And when interest rates were as low as they were artificially for as long as they were, then you could capture the greater's fool's theory, which just means I'm going to buy something and I'm going to sell it for a higher price. However, that is no longer the case. And so I've had to have a lot of conversations with investors to say, we got to get back to the grassroots and fundamentals of real estate investing, which is intrinsic value, understanding the cash flows that are current in the pro forma cash flows. How do we actually get there? And then putting an actual discount on that and making it an educated bet. And I always say too, like people say, well, why are you doing a deal right now? Don't you think the shoe is going to drop? Look, purchase price is permanent and financing is temporary. And I think that is something you have to keep in mind with real estate investing, because I think there's a lot of folks that, when we were doing fixed rate financing 2 years ago, when we could have taken all these floating rate debt options and we did not, said, why are you doing that? Well, now they're screaming from the rooftops saying you guys are geniuses. No, it was just something we weren't willing to do to try to juice the returns and try to mitigate this risk. And now look at where we're at. So I think that's the same thesis I'm taking here and saying, look, investors, 20% IRR, the last 10 years was achievable. And here's what was going on at that point in time. Here's where we're at now. It doesn't make real estate a worse opportunity right now. It's still different, and you still need to look at it from a diversification standpoint. I think that's the key in talking with investors right now, because at the end of the day, yes, you can keep your money in, whatever treasuries for 4.5%, 5%. And so that's an option. That's a short-term option for you, but that doesn't mean that you're still going to get all of the depreciation, equity buildup, appreciation, and the ability to use leverage on real estate deals. And so I think that some just aren't going to move off of what they're doing right now, and that's okay. They're going to wait, and they're going to wait, and probably going to wait too long, and then they're going to enter in the market when it's going back up, and they're going to miss those opportunities. And so I think that's kind of just investor psychology that Howard Marks talks a lot about in his books, Mastering the Market Cycles, and different books. But the really intelligent folks that I know that kind of look at real estate as dollar cost averaging, like I'm going to put a certain amount into real estate no matter what's going on every single year, are going to be the winners because they continue to allocate there. It's been proven over time. You got to have a long-term strategy here. It's not short-term. And I think that's the biggest philosophy change is, we're not flipping apartment complexes anymore. We're buying real estate for the intrinsic value.
Yeah. And hey, listen, just because you're doing this doesn't mean you can't go back to multifamily.
That's right.
Right. It's there's a whole lot of different asset classes, and I think it's very important for any real estate entrepreneur to really consider what's going on in the market and try to meet that demand. Like, because I'm in the same boat as you, right? It's like I love multifamily, I still buy multifamily, but you know what? Right now, I'm looking at it and I'm like, you know what? If I can build the stuff, I'm just going to keep building it.
Mm-hmm.
There's a need for it. And if I could do net lease, I'll do that. So whatever the case may be, it's kind of like being opportunistic around what's going on in the market and trying to serve the market, because the market is what rules, not and to be hard-headed about what you want to do next, just because you're going to put yourself in one bucket. You're only asking for trouble, in my opinion. But yeah, that's absolutely right. So now, one last question in terms of financing about this stuff. I know financing is at the top of everybody's list here. Are you finding financing is still okay? Are you doing a lot of owner financing these days? How are you handling that part?
Yeah, I mean, look, we're positively leveraged on all of these real estate deals. And so that just means that we're going to look at 500 deals to find one, and the basis has to be as good as it needs to be to make it make sense where current interest rates are. So that means we're going to do a whole lot less deals, unfortunately. However, we're still working with neighborhood and regional banks, regional and local banks, and, these are just recourse loans to the general partners. And so we'll go out and work with a regional bank to, put the business plan in place and say, look, this is how much construction we need or we think we're going to be doing. And, the rate has to be where it is, which is, I think, close to 7.25% or 7.5%, which means I've got to go purchase this, for 8.5% to 9% cap rates. And that's kind of the philosophy. And so, that while that, those deals aren't happening a lot, that's going to keep us in good shape and keep us in a safe place long term. And one thing we have been doing is at least negotiating a whole lot less prepayment penalties. So, if the rates do drop substantially, then we can either refinance with the current lender, or we can get out of that loan and go place a new loan on that real estate deal for less, fees than it would be previously. So I think those are all things that we've been doing to try to mitigate some of the risk on the debt side. But yes, we took this out to 27 different regional and local banks and only got term sheets back from 5. So it's definitely it's definitely closed up.
Now.
Absolutely.
Yeah,
absolutely.
It's tough right now. Really is great. Well, we covered a lot here today, especially the commercial side. I'm actually quite pleased that we're talking about this, because I think it's very timely, especially where we are right now with multifamily and where I think where guys like us are really going after. So, aside from that, what sort of bulletproof advice would you have for someone that is looking to invest right now? They're not really sure where to go to. What sort of bulletproof advice would you tell them? I'm always looking for ways to find that passive bulletproof cash flow in my portfolio. Now check out one of my favorite asset classes, net lease. Download my latest book at guide2netlease.com.
Yeah, it's probably similar to what I have said in the past, but I think that continual growth as an individual and as an investor is extremely important. And so in times that you may be sitting on your hands a little bit, more than you were previously, use that time to skill up, find an opportunity to add a new skill or just be more well-read. And so there's a lot of things going on in the world, and you can get caught up in a lot of different headlines, geopolitical risks, interest rates, recessions, all these different, election coming up, all these different things. I think it's a good time to study history right now, because while what's happening now may not have happened in our lifetimes, it surely has happened in the past. And so, I think that understanding that and understanding cycles is extremely important, not just business and credit cycles, but geopolitical cycles and all these different components. So I've been really studying Ray Dalio's The Changing World Order. I've been studying, Phil Anderson's the 18.6, year real estate cycle, because I have not been through them personally, but they have happened in history previously. So just been doing a lot of reading on history to understand what might be coming next. And there are similarities. Mark Twain, I think, said, history doesn't repeat itself, but it surely does rhyme. And so we need to understand those rhythms, those cycles. And the only way that you can do that is to look back in history to see what has happened previously, to maybe make some educated bets going forward. And so I would highly recommend people read books about history and investing historically and psychology of investing right now, because it's really easy to get in a your blinders on in what you're looking at and forget about history and what has happened previously. So continue to educate yourself, continue to skill up, learn history, understand cycles and rhythms, and I think you're going to be okay.
Yeah, and study the greats. You mentioned Sam Zell. He was a great man, great real estate investor. Certainly not perfect, but he did a lot of good stuff. All right, guys. Well, if you want to reach out to Logan, you can reach him via his website at ftwinvestmentsllc.com. Listen, guys, creating new habits takes time, and really what it comes down to is surrounding yourself with like-minded people, getting good coaches, reading a lot of books, take some personal accountability, and forming some good, strong habits so you can be positioned for success. All right. Thanks for tuning in, guys. I'll see you next episode. Take care.
You've been listening to the Bulletproof Cash Flow Show. We hope you've enjoyed the show. We know we had fun. Make sure to visit our Apple Podcast page and leave us a 5-star review. We hope you've gotten some useful and practical information from the show. For real estate coaching, events, and resources, hit up bulletproofcashflow.com. Till next time.
No information in this episode should be considered specific, personal, or professional advice. Any investment opportunities mentioned on this show are limited to accredited or sophisticated investors. Any investments will only be made with proper disclosure and subscription documentation and subject to all applicable laws. Please consult an appropriate tax, legal, real estate, financial, or business professional for individualized advice.